The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, it is Thursday, the 6th of March. Welcome back, Jeremy. Good to see you.
Hi, Gareth. Good to be here.
Yet another very interesting week. We've had a little bit of news flow from some UK stocks that we can talk about in a couple of minutes. But before we get to that, I'd be interested to hear what on earth you've made of the extraordinary goings-on in the Oval Office and much more broadly since we last spoke.
It's very difficult to know where to start. But yeah, I think probably after the shambolic events between Zelensky, Trump and J.D. Vance in the Oval Office and the weekend's politics, which were dominated by attempts to assemble a coalition of the willing in Europe at London's hastily arranged defence conference, Europe and its leaders feel the need to fill the void left by America's withdrawal of support to Ukraine, which they seem to have doubled down on this week. And potentially, while they're doing it, let's go the whole 9 yards and assume that they're no longer there as a fully fledged member of NATO. So the implications of this scenario are very real and require renewed appraisal of many issues that successive generations of European leaders generally have chosen to ignore.
Yeah.
This week, the sort of spotlight's been on Germany and its whatever it takes moment to support Ukraine and defend itself. And the consequences of that are that Germany is getting its checkbook out. And this is come in the form of a 500 billion euro defence spending fund, which is being proposed, which at long last is a scale of fiscal commitment that is broadly on a par with what the US has done in terms of their Inflation Reduction Act, etc., over recent years. So these are pretty history-defining moments, I would say.
I wonder if we're at a point where Germany, which obviously for historic reasons has been very reluctant to get involved in any kind of military action, now it's ironic that they're the ones who are being almost sort of forced into it and leading from the front in terms of making sure that it happens. But actually, the timing could be very good for the German economy because they've been worrying for a while about the car industry. And if suddenly investing in defence or defence-related projects and infrastructure and people and deployments, then that could be just what the German economy needs, a bit of a shot in the arm.
Well, I think the financial implications are that German borrowing costs have risen more in this week than at any moment in recent history. And the yield on the 10-year benchmark German Bund is now at its highest level in at least 25 years, probably longer. Yeah, and at the same time, German defence stocks, German industrial stocks, German equities have had their strongest performance in years. The German equity market yesterday was up 3%. So these are big moves. Europe is saying something and the market is believing them. And as you say, Germany has been the most reluctant to do anything about their desire to help to solve the Ukrainian problem. The most prominent of which is that it has constitutionally, until recently at least, been prevented to spend more than 1% of GDP on defence. Now, that's clearly changing. It's got out the window. And we've got to sort of really try and get our heads around the consequences of all this.
Yeah, clearly markets, both debt markets and equity markets, are absolutely showing that they believe that the German government is going to spend this sort of money and act in this way, which is interesting because there isn't really a German government in place yet.
Yeah.
There's still a bit of work to be done to get that sorted out, from what I understand.
And that is the remarkable thing. Because obviously the focus has been on Germany, but essentially it's a European problem. And Europe has structural issues. One of them is they don't have a common defence policy. They don't have a leader. Henry Kissinger used to say, if I need to call Europe, who do I call? I don't know who to call. And it's still a problem today. Far from it does it have clearly defined political leadership. It's been deindustrializing, led by Germany, and it doesn't have an energy policy that's capable of supplying the equipment to fulfill the new desire to defend itself. So money is one thing, but actually making the weaponry that's required to fulfill these commitments is quite another thing. And for that, you need cheap energy, and ideally, you need energy, the supply of which you have control of. And Europe doesn't have that. So these are the issues that they've got to get their head around. And on the politics of it, the leadership states, we've got a newly elected German chancellor that has yet to build a political mandate through alliances with other parties. In France, we've got Macron, who appears to only have a pretty short lease over the Élysée Palace. And Meloni in Italy, it seems to be too closely allied with Trump. By the way, doesn't have nuclear weapons. All of a sudden, the UK can play quite a strong role here. And the UK, as we've discussed previously, sort of politically and economically, is sort of almost by default assuming a greater leadership role within the wider Europe on these matters. But as William Hague put it this week, he said such a generational moment will require not only much higher spending on defence, but policies across governments that create here and among our neighbours more resilient countries that can stand up to themselves. And I would say, in saying that, he's reflecting the fact that we're being forced to move down Maslow's hierarchy of needs and prioritise our basic requirements for survival. And all of this means that we can do with a bit of economic growth. And I think the starting point is you need lower energy prices and also some greater control over the supply of our energy. And this is not just a UK problem, it's a wider European problem. We don't have that.
No.
The Americans do. There's lots of other reasons for the American exceptionalism, but ultimately they can do what they're doing because they have gone from, in the last 20 years, from being one of the world's largest importers of energy to being its largest exporter. And there is no reason why Europe can't follow suit. The constraint on Europe's ability to produce its own energy is political, not geological.
Yeah. It'd be interesting to see whether some of the new political faces across Europe, in particular in Germany, are prepared to move that dial.
Yeah, but it seems at the moment any attempt to reconciliation just gets blown out of the water almost immediately by the White House. I think the policy is to keep people on their toes at the very least, if not under complete paralysis of uncertainty.
We've had that paralysis and uncertainty just this week on the tariffs that Trump had previously announced, and then the complete reversal on the automotive sector, which came from nowhere.
Absolutely. And these tariff uncertainties have continued to drive wider market volatility. As you say, China and Canada have responded with countermeasures targeting US companies and US markets. And the other feature this week is that all these developments are being factored into currency markets. So we're beginning to see some quite significant moves in currencies with sharply diverging trends between the euro and the US dollar, with the dollar continuing to weaken and leaving sterling at its highest level in 4 months relative to the dollar and pretty much back at its sort of post-Brexit average. So all other things being equal, a weaker dollar provides relief for risk assets and for investors outside of the US. Unfortunately, the UK still seems to be on the edge of it all. Europe is powering ahead. China's had another pretty good week, and the US is sort of spinning its wheels a bit.
And in terms of that weaker dollar, if that's on the view that US interest rates are likely to come down or be able to reduce over time, is that because the signs of a US slowdown are becoming more frequently seen, do you think?
Yeah, there is increasing evidence of a deteriorating US economy out there at the moment. And a lot of people have got a lot of reasons why this might be happening. And I think it's too early to blame tariffs. I think it's far more likely to be a hangover from the higher for longer interest rate policies and the sort of the lag impact of tighter monetary policy of 18 months, 2 years ago. But whatever the reason, the widely followed Atlanta Fed GDP now measure has continued in the last week or two to show sharply deteriorating US economy in the first quarter of this year. Earlier this week, it recorded a minus 2.8% Q1 GDP number, which is just a step change lower. So the sort of typical of the last few months of between 2.5% and 3% positive.
Yeah, that's a big change. Yeah.
That's a huge change.
Yeah.
I think there are reasons to get quite nervous about the performance of the US economy. And that will be playing its part on lower yields and, a weaker currency. All of which I think I've mentioned before. One of the defining differences between Trump 1.0 and Trump 2.0 is he doesn't talk about the stock market. He doesn't really talk about financial markets at all. And I feel that's probably an achievement of the Treasury Secretary, Scott Bessent, telling him that the stock market doesn't matter, not for the time being. Worry about the bond market. 10-year yields are what we've got to worry about. The fact they're going down, recession or no recession, is good news for this administration in the near term. If they're going to have a recession, let's have it now and get it out of the way before the midterms.
Yeah, it feels like it could well be heading that direction. But as you say, if that's manageable and they get it done early, then yeah, you'd think that would be the right message. Yeah.
What about you? What have you noticed in the UK and elsewhere this week?
Yeah, from the UK microcap sphere, there's been a couple of things that caught my eye. First of all, on the progressive side, one of our clients, Severfield, had what's, to be honest, a relatively challenging trading update. Severfield's involved in the design and manufacture of installations and buildings, mainly focused on structural steel. And unfortunately, this week they reduced guidance for the year for FY25. It's a March year end, and also for FY26. We don't have FY27 in the market yet. The issue really was that they're seeing sluggish end market demand, just difficulty getting customers to commit to new projects. The reality is that really just reflects absolutely what we're seeing across so much of the UK economy at the moment, where you've got poor sentiment, sluggish demand, and lack of investment commitment or investment opportunities being taken. So very frustrating. I think Severfield, they're still very well placed in that market. And okay, it's a troubled market at the moment, but hopefully if it does start to recover and rebound, they'll be well placed to benefit from that. And surely all of this talk of renewed spending on infrastructure and defence and large projects, at some point it should start to feed through to markets like the one that Severfield populates. So hopefully it won't be all that long before they'll start to see a recovery in that end market, which would be good for them and also good for the rest of us.
Yeah.
One other piece of news that I saw was XP Power. They announced a fundraising this week. They raised £40 million, a placing largely from institutional investors, but they also raised £1 million in retail, which was nice to see them using one of these various retail platforms that have sprung up in recent years. I think they're using that largely to fund or to bolster their balance sheet while they fund a big litigation, legal action that they're involved with. So it was a slightly differently structured or styled fundraise, but good to see that the markets were open, the cash was there when they needed it, and the London Stock Exchange is still capable of delivering fundraisings in a relatively short time frame and to order. So the supply of capital is still there.
Yeah, I think despite being on the sidelines and despite all the angst that has been expressed around the state of the UK's stock market and ability to raise capital, actually, as the XP Power one showed, the market is still open and deals can be done.
I think that's right. And if sentiment starts to improve and companies do find reasons to raise capital to invest, then even better. And fingers crossed we can see that move forward across the rest of the spring. So looking ahead, tomorrow's a big day with US non-farm payrolls.
Yeah, I think given what I was saying earlier about concerns about the health of the US economy, the figure there is going to be closely watched, albeit month to month. These figures are pretty volatile. But we've also got US inflation data next week, which I think will probably be more significant. So I think we could get the sort of dreaded stagflationary combination of indications of lower growth and stubbornly high inflation, which is always a concern. And with growing fears of a US slowdown, they could be quite consequential. But as with the last 2 or 3 weeks, I also expect that Donald Trump's team's sort of let's move fast and break things approach to things in Washington is probably going to overshadow everything else.
Yeah, that's more likely to be the headlines. But yeah, let's hope the data's good nonetheless. But it'll be interesting to see how the US economy is performing. So all good stuff.
Stay tuned for another exciting episode.
Indeed. We'll be back this time next week to see what has actually happened. So Jeremy, great to speak to you again. Good to catch up. And we'll chat next week.
All right, Gareth.
Talk to you then.
Brought to you by Progressive Equity.